Hi, everyone. Good to see you back. And we're going to start our first session in strategic financial management. And today we'll be learning about accounting information, and we'll also be learning about the classification based on the scope of accounting in detail. So before we move on, what do you mean by accounting? What do you mean by accounting? I'm sure most of them are aware of the term accounting. So as you can see, this is the AAT terminology. According to AAT, accounting is a process of recording, classifying, summarizing, analyzing, and interpreting the financial transactions and communicating the results thereof to the persons interested in such information. Now, accounting is a combination of information science. What is information science? We are analyzing, collecting, and organizing the information. Imagine you are conducting a business. You're an entrepreneur. So you do transactions, maybe 10, 20, 30, 40, 100, 200 transactions a month or per year. Now, all these transactions needs to be recorded. Why? Because you will need evidence in the future. You need to know what's going on in the business. Therefore, we use the accounting process, right? We use accounting as a process of recording, classifying, summarizing, analyzing, and interpreting these financial transactions and communicating the results thereof to the persons. Who are these people? There are people who are interested in the accounting information. You call them stakeholders, right? You call them stakeholders. Example for stakeholders, there are shareholders. You have the government, creditors, debtors, suppliers. Yeah, so they are interested. They need to know what is going on in the business. So we will be recording whatever the transaction that occurs in the business, we'll be recording. This is a cash inflow, this is a cash outflow. So if the business purchases stock or inventory on credit, we record it. Sales on credit, we record it. And then we classify and summarize. What are the income? What are the expenses? You have the categories under accounting. Classifying, summarizing, and then analyzing and interpreting. So when you interpret and analyze the financial transaction, you use different models or different methods. And some of them will be ratios. You'll be learning ratios under this course. You'll be learning probably during the session number 9 or 10 towards the end. So you'll be learning about this in detail. So now comes the question, what types of information do we record? We only record financial information. You need to remember, when it comes to accounting, it's only quantitative. So accounting is quantitative in nature and not qualitative, right? So this isn't an abstract science. This is information science. So the more you do, the better you be at it. Yeah, so you say practice makes perfect. That's accounting. So if you need to be perfect, if you need to get more experience in the field of accounting, you need to practice. So this is more of a practical subject than theoretical. Now, accounting information is classified into 4 main areas of accounting. Now, I've only given 3 areas, but let me explain. Let me give a brief introduction to the first classification, which is called as bookkeeping. Right, bookkeeping. You would have heard this term, bookkeeping. It's not used anymore, but you would have heard it before, especially people who had done AAT or SIMA. You would have come across this word bookkeeping. So bookkeepers, who are they? They're responsible for all the information that is collected and taken into consideration. And now this gives us to the rest of the 3 categories: financial accounting, management accounting, and cost accounting. What do they mean? Let's move on to financial accounting. What is financial accounting? Now, financial accounting is a combination of statement that provides financial information, very important for you to understand, to internal and external parties of an organization. Financial accounting is used by both internal and external parties of an organization. And they're usually prepared on an annual basis or quarterly when the organization meets or whenever the organization feels like preparing financial accounting, financial statements, they can do so, but it's mandatory to, it's mandatory to prepare every year if you are with the stock exchange. If you register with stock exchange, you have to prepare your financial statements and audit it, but it has to be audited by a third party, and then you have to publish it. You have to publish it to the public if you are registered with the stock exchange. So when financial statements are prepared, you have to follow rules and regulations, accounting policies, and certain standards. You would have heard of IFRS, IAS, International Accounting Standards. So when you prepare financial accounting, you need to follow certain rules and regulations. So organization A cannot prepare the financial statements the way they want. B cannot prepare the way they want. So there is a particular procedure. There is a particular format that every organization has to follow. Components of financial statement. Statement of comprehensive income. It's also called as P&L, profit and loss account. Then you have statement of financial position, also called as balance sheet. Statement of changes in equity, cash flow statement, accounting policies, and explanatory notes. Right. So now what do you mean by statement of comprehensive income or income statement? What does this mean? Statement of comprehensive income statement. Now, when you look at this, the profit and loss account at a glance, you will be able to find out whether the organization has earned a profit or has it bear a loss at a glance. So at the end of the accounting, at the end of the income statement, you will be able to get information about the profit or the loss of the organization. And you're also able to find out the sales revenue. What is the sales income for that particular year? What are the other incomes earned by this organization? What are the expenses of the organization? So everything you'll be able to get information about everything related to income, expenses, revenue, profit or loss from the income statement. And now we're moving on to statement of financial position or the balance sheet. What does this mean? Statement of financial position or balance sheet, this gives us a snapshot of the organization at a particular time period. When you write, you would have seen the heading on a balance sheet, on a statement of financial position, they would say SOFP as at this particular date. But when it comes to profit and loss, they would say profit and loss or income statement for the year ended 2025 or 2024. Is that clear? And now we're moving on to statement of changes in equity. Now, this gives us the information about the retained earnings or the owner's contribution to the organization. And now, cash flow statement, any cash inflows or cash outflows is recorded in here. And then you have accounting policies and explanatory notes. I'll show you this. Give me a second. Okay. Can everyone see the screen? Yeah. Is it possible?
Yeah.
Yes. So this is an annual report. This is a Doha Bank in Doha, I guess. Yeah. So this is what an annual report look like. This is how an annual report looks like. So I'm just going to go down, all the way down. If you go all the way down, you'll be able to find out the annual financial statement. So you have to go all the way down, and then you'll be able to find out here. There you go. So consolidated statement, that is a group one. Let me see what they have the individual accounting. No, they don't. No, they don't. All right. So this is how. Oh, where did it go? You have to go all the way down. And there you go. So consolidated statement of financial position, you can see as at 31st December 2021. See that? As at. So is it this particular date? As 31st December 2021, this is a consolidated statement of financial position. So if it is 1st January 2022, okay, this is not what you're going to get. It'll be different. So in a statement of financial position, as you can see, you have the information about the assets, about the liabilities, and the equity of the business. And then you have the income statement. You also call this profit and loss account, right? P&L. Now here, you will be able to find out the profit of the company. Profit of the company. And now, I want to explain what it means by the term accounting policies and explanatory notes. Now, you can see here, under each of these entries, you could see numbers. Note 21, 22, 23, 24. Now, you might wonder, what does this mean? Yeah, so you can see here, let me go to assets, okay? Now here you have the assets, note number 8, right? Liabilities, note number 15. Now here in the SOFP and the P&L, you get the information as a summary. In a nutshell, this is what you get. But if you go all the way down, right? This note number 8, I'll show you where note number 8 is. Now, this is going to give you a detailed view of the cash and balances with the central banks. So let's go all the way down to number 8. Still number 4. Oh, there you go. Note number 8. So you have all the information related to cash and cash with central banks. See this? So note number 9, again, you have all the information. Note number 10, all the information. Get it? So this is the category that we learned about accounting policies and explanatory notes. Let's go back to our slide. And now I'm going to give you an introduction to management accounting. What do you mean by management accounting? Right. When it comes to management accounting, managerial accounting is aimed at providing internal information necessary to make business decisions. Now, when it comes to financial accounting, I told financial accounting is used by both internal and external parties. But when it comes to management accounting, this is only used by the internal parties of the organization. And why is that? Because this particular accounting classification contains information that is related to pricing, competition, budgeting, which is only related to the internal of the organization. Now, if the competitors get to know about this information, the company is in deep trouble. Therefore, managerial accounting or management accounting can only be used by the internal parties of the organization. So here you're going to learn about pricing, What is the price of the product? What is the profit margin of the product? Yeah, so you're going to learn, or you're going to get information related to this under management accounting. And when it comes to a finance manager, there are three types of decision that is taken by a finance manager: investing decision, financing decision, and dividend decision. Now, investing decision, what do you mean by investing decision? Now, under investing decision, you're going to learn which project should we invest. Is it project A, project B, or project C? Yeah, which project will give us a return? So you have short-term investment decision, long-term investment decision. What is short-term investment decision? These are the investments that are expected to mature in a short period, which is less than a year. And when it comes to long-term investment decisions, these involve investments that are expected to provide returns over a long period of time, usually more than a year. For an example, short-term decision, I can give an example, like investing in a treasury bill or bonds, short-term bonds. And long-term investment decisions like purchasing a property, land, buying expensive machinery or capital equipment comes under long-term investment decision. And now, financing decisions. What do you mean by financing decisions? Financing decision means here you're going to find out how do we source our business, right? How do we get the money that is required by the business, right? Is it through, again, you have short-term and long-term, right? So here as well, you have both short-term financing and long-term financing, just like the investment decisions. And then finally, we have the dividend decisions. What do you mean by dividend? Who can tell me? What do you mean by dividend? Have you heard of this term before? Anyone who's invested or bought any shares in the stock market? No? Nobody?
Yes, ma'am.
Okay. Yes, okay. So then
Yes,
you
ma'am.
must be familiar with the term dividend. What is a dividend?
To be honest, I don't know.
You don't. Okay, what about ROI?
Yes, ma'am.
No, you don't know. Okay, never mind. Right. Also, when it comes to dividend decisions, now when you purchase stocks in a stock market, you get a return. Yeah, that is called as dividend. Right, that is called as dividend. But when it comes to a company's point of view, this is a critical component of a company's management strategy. Why? Now you have to decide what percentage of dividend are we paying the shareholders. If we increase the percentage, what's going to happen to the business? What's going to happen to the organization? Profit is going to go down. If we decrease the dividend, pay, the shareholders are not going to be satisfied with you. See, so this is a crucial decision. You increase the dividend, shareholders are going to be happy, but the profit is going to go down. You decrease the dividend, the profit is going to go up, but the shareholders are not going to be happy. So you have to make sure, when making dividend decisions, when making dividend decisions, you have to make sure that you're able to balance both parties. Now, this is management accounting. And now let's move on to cost accounting. What do you mean by cost accounting? Now, cost accounting provides information to the managers concerning the costs related to the production activities. Now, the cost accounting is used, or the information of cost accounting is used by the managers to plan, control, and make decisions related to costs. For an example, if you're planning to produce or manufacture a product in-house, now you have to decide from where are we purchasing the raw materials? Which supplier are we purchasing the raw materials? Now, again, this is also a crucial decision. You have many suppliers in the market. Say, for an example, I say supplier A, supplier B. So let's analyze. Supplier A, the raw materials sold by supplier A is cheap. Okay. The raw materials sold by supplier A is cheap, but the quality of those raw materials is low. Whereas supplier B, the quality of the raw material is high. It's of good quality, but the raw materials are expensive. Okay, let me ask this question. Now, who would go or who would choose supplier A? You can type one on the chat box or you can just raise your hand. Who would go to supplier A? Okay, supplier A or B? Type on the chat box. A or B? Who would you choose? B, okay. How about the others? A or B? B, okay. Everybody's gonna go with B. So you just can't select B or A. You have to tell me why you chose B and not A. What about the others? Quick, quick, quick. A, okay, that's a different answer. Okay. So I got two B's and one A. How about the others? Okay, I'll come to you, Zahra. Hang on. Let the others also give their response. B or A? I want everyone to answer the question. As I told you before, I need this class to be interactive. I don't want to be the only one speaking. Now, since it's the first session, I'll do the talking, but then the rest of the session I'll be asking you a lot of questions. So be prepared. B, okay, everybody's gonna go with B. Right. Zahra, why B?
When it comes to the quality, so you said that quality is high, but the price is expensive.
Yeah.
So I think when it comes to the product quality, so we go for the B.
You're gonna go for B, but it's expensive.
Mm.
So the company has to spend a lot of money in purchasing raw materials from B. It's expensive.
Yeah.
Yeah, so now what? It's okay. Because when
Yeah.
it comes to a company, they also have to look into other expenses. Their expenses are just not raw materials. They have other operation expenses. Yeah. Now, for example, machinery, they have to look into the machinery, electricity, rent, labor. They have to look into all these expenses. Yes. So
Yeah.
raw materials is one aspect. So why do you say that the company has to go with B? Even though it's expensive. Okay, one thing that you said, yes, it's of high quality, but it's expensive.
Yeah.
So anyways, your answer is B.
It
You're gonna
really
stick with
depends.
it.
Okay.
I no, you have to tell me why. If it is B, okay, you say, okay, I'm gonna stick with B. Tell me why do you stick with B?
Because some companies they see for the quality.
Companies
So
see for the quality or the customers looks for the quality?
sorry,
Who looks?
customers. Yeah.
Customer looks for the quality.
Even
Obviously,
for the
companies are not gonna be
quality,
bothered.
even though
Yeah.
even though the price is expensive, some customers they see for the quality. So if
Mhm.
if the quality is high, means they can use it for a long time, and there
Mhm.
is a
Mhm.
durability rather than the A.
Mhm.
So that's why I
B.
choose this B.
Okay.
Yeah.
Okay. Good. Good.
Yeah.
Yes, Zira, you said it depends on the end user market. What does that mean?
Well, let's say if the business is into a niche and their target market is um, customers who are willing to pay for high quality product, then
Mhm.
the supplier would be B,
Okay. Good. Mhm.
and vice versa. Again, let's say if the business is into covering more customer base
Mhm.
where they wanted to reduce or give at a low price, or like let's say of fair price or the
Mhm.
competing price, then the supplier would be A.
Yeah. So both has pros and cons, right? So if the organization go with supplier A, yes, they will be able to purchase raw materials at a lower cost, but the raw materials of low quality. So the products that is manufactured by this organization will be of low quality. Customers will purchase because it's cheap, but in the long run, they're going to lose customers. Why? Because, obviously the customers would want the products to be durable, at least for a couple of years. Yeah. So the company actually have to think whether to invest in B or A. And again, when it comes to B, supplier B, yes, it's expensive, but in the long run, you're going to have loyal customers because customers are going to keep coming back to you again and again because your products are of high quality. So as Zira said and as Zahra said, yes, when it comes to, it all depends on the end customer because some customers, they want cheap products, or you say less expensive. Yeah, cheaper products. Yeah. So they want cheap products and sometimes they don't really care about the quality of the product. So for those customers, you can purchase from A. And whereas the high-end customers, there are customers, they don't mind paying a high price if the product is of good quality. So for these customers, you can choose supplier B. So as you can see, I know, this is just between two suppliers. Now just imagine a finance manager in a company, in a multinational company, making this decision. Now, obviously, you're going to have 100, 200 suppliers giving that quotation. Imagine the stress, imagine the pressure that this person is going to go through in choosing the suppliers because it's going to have repercussions. So if you take raw materials of low quality at a cheaper price, repercussions. You purchase raw materials at a higher price of high quality, again, repercussions. Because when things are expensive, when you purchase raw materials that are expensive, it's gonna sort of, mess up with your operational activities or operational, like cash flow, cash inflow and cash outflow. The operational cost is going to be messed up. So everything has to be looked into. That's why, when it comes to a finance manager, their decision making is crucial because finance manager is not only for the finance department. This is like the nucleus of the organization. Because when it comes to the financial or accounting, they are linked to all the other departments. Say, for example, the marketing department is in need to advertise. They need to launch a product. They need to test a product. From where do they need they need some not investment. They need money to run this or to launch a product, to test a product, to advertise something. They need money. So who do they come to? The finance manager, HR. They need candidates. They need employees. There are certain job responsibilities and they need employees. Where do they come to? The finance manager. Why? To discuss about the salary. Okay, what's the pay? So when it comes to the finance manager, it's like they're the central party in the organization and linked to all other departments. All right. So here, as you can see, when you go for lower quality raw materials, it may help to keep the costs down along the process by keeping the process simple and may be able to cut off a few steps too. What does that mean, Kosala? Could you please elaborate? How does it, how will it keep the cost down?
Yep. So if you are go for a quality raw materials and if you compare quality and unquality raw materials, the unquality ones may contain impurities. So when you're making product with the raw materials, you may have to go through several extra steps if your materials are not good, not quality enough. So that could help along the process with machineries, with the workers, everything. So that's what I was thinking about.
Good thinking. That's really good. Yes. So what Kosala said is, investing in high quality raw materials now is going to save you money in the long run. Is that right, Kosala? That's what you said in a summary.
Yep.
Yeah.
That's right.
So if you're investing in low quality materials, purchasing them at a low price, you will have to face problems every time. So that's really a good point. So again, let's move on. Here, the management uses cost accounting information to make decisions pertaining to pricing. So what is the price of the product? Now, price of the product, you need to look into the cost of the raw material or cost of production. Let's say cost of production plus the profit is going to give you the selling price, right? So if you bring the cost of the production down, if you bring this down, you will be able to get the selling price down. So let's say profit is constant. We're not going to touch the profit. That's going to remain constant. So if you need to bring the selling price down, you need to bring the cost of production down. If the cost of production is high, maybe the raw material is high, the employees are high. Say, for an example, job production. What is job production? You produce customized product, right? You produce customized product, meaning the customer will place the order and the customer say, okay, these are my requirements. This is how you have to produce a product. This is the design. I want this particular color. I want the exact color that is in here. So these are customized product and the customers are willing to pay a higher price. So when it comes to job production, you cannot sell the product, or the customer cannot expect the product to be cheap, right? So because the cost of production is high. Why? Because you are producing customized product. So you're going to purchase raw materials. You will have to get skilled laborers. So obviously cost of production will be high. Therefore, the selling price will be high. This is just an example, right? So in other terms, if you want to bring the selling price down, you can also put the profit down. But then again, there are certain repercussions making this decision. So pricing is crucial, right? Selling the product. So you have to sell the product at a reasonable price so the customers will purchase from you. If the selling price is too high, the customers might not purchase from you. Then again, you have other strategies that you can use. Marketing strategies, branding strategies. Now, for example, Apple products. Yeah, if you take Apple products, even though it's expensive, people still purchase. Why? Because of the brand image. You know, have you seen Apple products advertisements? They're not that, you know, I don't think they're much into advertisements like Samsung. But when it comes to, you know, Apple products, you know, it's just simple. Yeah, their advertisements are simple, and the way they how do I say, how they make the impression to the audience, it's just amazing. Right? So when it comes to Apple products, even though it's expensive, people still purchase it. Yeah, so pricing decisions. So pricing decisions depends on the company, depends on the brand, and depends on their target consumers. Next, decision regarding whether to continue or discontinue a product. Now, if certain products are running at a loss, what can you do? Modify the product, find out what's wrong with the product, modify the product, and relaunch it. Or you can discontinue the product. Because why do you have to sell a product at a loss? There's no point. Yeah, so here you have to make the decisions. Then again, you can also do this. Find out what's the problem with the product. Why is it not selling? Then what can you do? Find out the reason. Get the feedback from the customers. And if they say, okay, this is a problem, this is why I don't like it, you modify it and you relaunch it. Next, we have production planning. Production planning. What are the cost of production? You know, cost of production, you have both fixed and variable cost. What do you mean by fixed cost and variable cost? You'll be learning everything in detail. You will be learning everything in detail, but just give me an explanation if anyone knows what's fixed cost and variable cost. L6 students, you guys know what variable and fixed cost is? Zahra, what is fixed and variable cost?
Variable cost means the cost that changes with the output.
Mm-hmm.
And the fixed cost means the cost that fixed in the entire production.
Excellent.
Example, the rent, like
Mhm.
the building cost.
Yeah. Yeah, very good. Thank you for that explanation. Yes, fixed cost means these costs do not change with the level of production or business activity. You produce 1,000, it's going to be the same. You produce 2,000, it's going to be the same. Now, for example, rent of the building, like Kaushi said, the rent, a company will pay the same rent amount each month, regardless of how much they produce in that building. It's going to be the same. And I usually describe fixed cost as a stubborn person. Yeah, stubborn people, they do not change themselves no matter what goes around them. They will not adapt. They don't like to adapt. So this is like your stubborn cousin. Yeah. So your stubborn cousin, fixed cost. What does that mean? It's going to remain constant, not it. He or she is going to remain constant no matter what happens around. Now, variable cost is the opposite, exact opposite of the fixed cost. This means these costs will change when the level of production increase or decrease. So variable cost increase as the production increase. So when you produce more number of products, the variable cost will increase, meaning it has a direct proportion to the volume of output. Okay, let me explain. So variable cost and the units, let's say units. So when the production of the units increase, variable cost will increase. They have a positive relationship. And the opposite. When the production number of units that is produced by the organization goes down, variable cost goes down. What about fixed cost? No, it's going to remain constant. He doesn't care. Whether you produce more or produce less, it doesn't matter. You have to, now fixed cost is going to remain constant. Now, examples for variable cost, I can give you direct materials, raw materials, yes. Raw materials, as I said, supplier, right? So raw materials, if you're purchasing, now raw materials used in production increase as more products are manufactured. Then I can give you other examples of delivery costs. Yeah, delivery costs, the cost of shipping increases with the number of units that you ship. So these are some of the examples for variable cost. And now we're moving on to the next component, which is cost control. What is cost control? Again, you will learn everything in detail. Now, I'm just touching the surface in the introductory session. So cost control, now this is essential for maintaining profitability and ensuring that the resources are used effectively and efficiently in the organization. Right? So in cost control, we have something called cost allocation. Here, we're going to identify the costs. So we're going to allocate the fixed cost and the variable cost to different products and departments. Here we do budgeting, which you'll be learning in detail later. You will also be learning variance analysis, right? Cost reduction. All comes under cost control. And finally, make or buy decisions. What is make or buy decisions? Now here, you're going to plan, okay, are we going to produce it in-house or are we going to buy it from an external supplier? Now, you will have to consider many factors like production costs, the capacity. Do you have the capacity to, do all these stuff, the quality? Everything will be considered when you make the make or buy decision. Okay, so now let's move on to the next part. So here we're gonna differentiate, or we're gonna compare financial and management accounting. As you can see on the column, we have 3 columns here basis of comparison, financial and management. And on the first column, you can see the basis of comparison. So you have user, nature of information, type period, objective, format, publishing, and auditing. When it comes to user, financial, as you know, it's internal, external parties, both parties, right? Internal, external parties. So internal as well as external parties. Management, only internal. So this is confidential. You're not supposed to leak any information that is happening inside the organization to other parties. Yeah, nature of information, only financial, only quantitative. Financial information is quantitative in nature. There's no qualitative. Now, if you look into the profit and loss account or the SOFP, you can't say that the manager has made a bad decision. You can't say that because it's only quantitative. Now, management accounting, it's both quanti and quali. It's a combination of both, right? It's a combination of both. Time period, annually or yearly, quarterly. It depends. Management no specific time period, meaning whenever you feel like, whenever the manager feel, or when there's a requirement, not feel like, I should not say that. When there's a requirement to produce management reports, then they will do so. Objective, provide financial information to outsiders. Why do the outside people need financial information? Why do you think? Do you need financial information of other organizations? Yes or no? Okay, people who are in the stock market, why do you need financial information of the organization? Okay, when you planned to purchase stock from different companies, so what were the factors that you considered before making the decision? Who has stocks? Who has purchased stocks from the share market or from companies? Please raise your hands. Okay, now nobody's raising the hands because they have to answer my question. So I remember a lot of, some of them said that they have purchased from the stock market. Oh gosh, nobody's answering. Okay, profitability of the organization. Profitability of the organization, yes, that's one factor, yes. Okay, so when it comes to stock, okay, when it comes to share market, okay, so the investors, they need the information of the organization, the financial information of the organization, because investors, they will be doing something called the ratio analysis, right? The ratio analysis, again, you'll be learning everything in detail, but I'm just gonna touch the surface. So you'll be learning something called the, yes, to know the financial stability of the organization, good. So with the ratio analysis, you'll be able to find out whether this company is doing well or not. Then again, you also have to consider other stuffs as well, because when it comes to financial information, it can be manipulated. Right? Financial information can be manipulated, meaning you can prepare the financial statement in a way that when you do the ratio analysis, it's going to give you a good picture about the organization. So in other words, you call it window dressing. So window dressing is the act of manipulating the financial statements or the appearance of a company's financial position. So when you do the ratio analysis, you're like, oh, okay, this company is doing well. But in reality, it's not. So you have to look into that. Okay, you have to look into that. So anyways, you need this financial information to the ratio analysis to find out which company is doing well. Okay. Next, assist the management in planning and decision-making process. Format, yes, there is a specified format. When you're preparing the financial statement, you have to follow a specified format and you have to stick with it. And management, no specified format. So it differs from organization to organization. Publishing and auditing, yes, when it comes to financial accounting, it has to be published and audited by statutory auditors. Right, a third-party auditor has to audit it and sign it. Right, in the annual reports you would have seen Ernst & Young signed, meaning it has been audited. So management accounting is neither published nor audited by statutory auditors. And independent audit, mandatory for financial. Management, not mandatory. Confidentially, published publicly, highly confidential. And governing principles, yes, you have the GAAP, you have IFRS and IAS. When it comes to financial and management, there is no particular standard for preparing management accounting statements. And now moving on to cost and management. Cost, determination of cost and cost control. We learned about this in detail. Management, efficient and effective performance. Nature, mostly quantitative. Management, quanti and quali. Users, cost accounting reports are useful to the management as well as shareholders and creditors. And management accounting prepares reports exclusively meant for the management. Objective, assist the management in cost control and decision making. Management assists the management in planning decision-making process. Data cost accounting is restricted to cost-related data, and management accounting uses financial accounting as well as cost accounting data in their management report. So they use combination of everything. Publishing and auditing statutory audit of cost accounting reports are necessary in some cases, not all the time, like financial accounting. And when it comes to management, it's neither published nor audited by statutory auditors. So this is about cost, financial, and management accounting. So let's go through a briefing again. So we learned about accounting information. I said accounting information is a process of recording, classifying, summarizing, analyzing, and integrating the financial transaction. And accounting information is basically classified into 4 parts, which is bookkeeping, financial accounting, management accounting, and cost accounting. And then we learned about financial accounting in detail, and we learned about the components of financial accounting, which are the financial statements. And then we learned about management accounting, and I spoke about the 3 decisions, or the main types of decisions that is taken by the management accountants or finance manager: investing decisions, financing decisions, and dividend decisions. And then we also spoke about the cost accounting in detail, and we looked into some of the decisions that is taken under cost accounting. There are more. Okay, I just looked into the main decisions that is taken by that is taken under cost accounting: pricing, decisions regarding the products, whether to continue or discontinue product, production planning, cost control, make or buy decision. And then we also learned the differences between financial and management accounting, and the difference between cost versus management accounting. So thank you so much for attending this session. I'll see you in the next session.